You're listening to the Practical Wealth Show with Curtis May.
Hey, welcome to another episode of the Practical Wealth Show. So today we're going to talk about creating wealth, and I have the author of the upcoming book, Alejandro Szita. Okay, and so he is are you in California?
I am in California.
Okay,
yes.
he's a mortgage broker from California. And so what's cool about Alejandro is that we think a lot like he knows about infinite banking. And so we've probably been talking for 10 minutes before we started recording. So sorry, we're saying some good stuff. We should get this down. But he works with, and he's going to tell you about this specialty with entrepreneurs, with artists, and what was the third one group? Business owners, right? And and sometimes it was hard to get money as a self-employed person. So that's why I wanted to have him on. And so he's got a book upcoming that's not quite done, but it'll be done shortly. But I like his thought process. Money, what is it, how it works, and how you can use it to create wealth and prosperity for yourself and your community. Okay. And so what he does is teaches the fundamentals of wealth building, answers questions. And the real question is, what is money? We might start with that. And what is value? So welcome to the Practical Wealth Show.
Thank you, Curtis, and thank you so much for having me here.
Yes, my pleasure. So give me a little bit about your backstory. That was interesting. You came from Chile, and let's talk about that. And then let's talk about wherever you want to go, what is money, and then we'll just have a fun conversation.
Okay. So I was born in Chile. I lived in Chile in the period from 1970 to 1973, when we have a like a socialist government that took over the country. So I saw the transition, even though I was very young. I was like 7 years of age. I saw what happened before the socialist government, what happened with the socialist government, how that ended very messily. And I saw a lot of things. I saw that our currency got completely devalued. 1,000 units of the currency became 1 unit on the new currency.
Wow.
So a lot of what is happening today, I already saw it and experienced it when I was a boy of 7 to 8 years of age.
Oh, don't get me started with that. So let's go there for a second.
Well,
I thought that might have happened with Chile. No, because this play has been run before. Okay,
many times, and even before 1973. I'm a history buff. When you go back in time, you can go way to the Roman Empire, to the Greek Empire, and the same reasons that got rid of big cities like Athens, Sparta, on the Greek period, or Rome. It's the same play. I mean, the actors changed. We have more technology. Things look a little different, but basically it's the same principle at play.
And so there's nothing new under the sun. And so we keep trotting out new ideas that we see new, and we've got all these college students indoctrinated about socialism, Marxism, and it's never worked in the history of mankind. Yet we still keep trying to fix it, right? It all ends up in totalitarianism, right? And so the main things, guys, if you want freedom and you want to be in control of your money, right? Because capitalism believes money is best spent. You are the best person to make decisions with your money, right? And then socialism believes that capital is best in the hands of the state in central planning. So I've shown this, Alejandro, to kids. I was like, which one would you rather have? Oh, I want my money. Okay, you're not a socialist then, right? And you just got to break it down to them, right? Because everybody wants free. I mean, I had friends in Venezuela, right? And so I got, it's like 20 years ago. And it was Chavez was still there, like early 90s. Like first they started to say, oh, we got free college, we got this, we got that. Now look, so you hear all this Bernie Sanders stuff. So I'm gonna come off my libertarian reign. I'm sorry. So you got me triggered.
Not a problem, Curtis. What I wanted to say is this. One of the things that I detail on my book is what we call the actual wheel of how is wealth produced. How come we have all these things around us and we have such a high standard of living? Because compared to like 50 years ago or 100 years ago, even the poorer person today has a standard of living that is higher than a person that was mediumly rich or mediumly wealthy just 50 or 100 years ago. So there is this concept that we call the wheel of wealth. How is the wheel of wealth created? And one of the requisites without which the wheel of wealth does not work is freedom. freedom to actually transact. I'm not talking about freedom in an actual political sense, but in an economic sense. Freedom between, let's say, between you and I, that we can transact on a service or a product, meaning that you alone would decide if what I have to offer is worth it. And you alone would decide what is worth it for you.
Right.
And on my side of the transaction, I have the same rights and the same mindset and frame of mind. So between you and I, we will decide what to transact, and you and I will assign a value to it.
Right.
That process, we do it every day. We do it every day. We do it at home with our family. We do it when we go to the store. That basic process is the building block of everything. Once you start to interfere with that process, no matter the reason, it could be a good intention or a bad intention. It could be because you think it's best. Once you interfere with that, and once you interfere with that at a macro level, is when everything starts to come down, because it's against nature. It's against the nature of the participants on the transaction. And like again, I'm not talking on a political sense.
Right.
I'm talking on a purely
Economic
and transactional sense.
Yes.
And this is regardless of any society. You could go to China. Let's take China. China is a very good example. China, inside China, is not a communist system. China is as capitalist as we are today. One more thing very quickly I'm going to say is, like, when I was at the university in Chile, we had a course about Karl Marx. Karl Marx was a loser. Karl Marx was a loser not because he didn't make money. Karl Marx was a journalist who made a lot of money. For the time, he got paid about 100 pounds or 70 pounds for each article. This is in the 1870s. That was a real fortune. But his money skills were so bad, he managed to squander all of his wealth. About half of the children that he could have died because of malnutrition, because he wasn't there. He was not a good father. He did not create anything, by the way. He went to the British Library. He read texts from the 1600s and the 1500s from other philosophers that their names escape my mind. And that's how he came with the quote unquote capitalist theory. The word capital and the word capitalism was invented by him. So that's why I never want to use the word capitalism, because that's a word invented by Karl Marx.
By its enemy. That's right.
That refers to a personal opinion. You see, the whole of Marx's theory could be explained like this. Karl Marx says, you work on a factory, you get paid 10. What he called capitalist sells it for 50. Therefore, he's exploiting the worker, and therefore he's pocketing 40 because he's selling it for 50. He's paying 10. He's pocketing 40 that he shouldn't pocket. Therefore, he's an exploiter and blah, blah, blah.
Right.
His whole theory, all of his 7 books that he could not finish, called in German Das Kapital, which is basically stands for the capital or capital, he could never finish. So the guy that gave him the money, Engels, is the one that finished the books. He's a total failure. His theory is just personal opinion that is not even based on him. It's based on some guys from the 16th or 17th century.
Wow.
And today in the universities and in the halls of learnings, he's being elevated to the rank of philosopher. He's being elevated to the rank of visionary. And he was none of that. Actually, his life was he was a loser.
Wow.
So this is very interesting to see that all of these ideas we have today that we're using come from a guy that spent all of his time on a library just rehashing stuff that was already proven false already in the 1600s.
Wow.
Isn't that incredible?
That is incredible. Wow. All right, let's talk about. I know mortgages. Let's talk about, because I want to make sure I talk about your thing.
Okay.
Because we can have an hour on that.
Yes, totally. I know, but I
might come back and have you do that, because I like economics.
Yeah, I'm saying this because it pains me that we're taking decisions based on a loser from the 1800s.
See, that's the point. See, so he's coming from that. A lot of people are running from that, and they already see the signs of it here, and they're like, "Yo, America's so stupid. This does not work." And
it's not stupid. It's a battle of the mind. One thing that I noticed when I came to America, I don't know if you read the book 1984.
No, George Orwell.
George Orwell was not his real name. He was a soldier on the Revolutionary War in Spain. In the 30s in Spain, the communists actually tried to take over the country. And there was a civil war in between 1930 and 1936. George Orwell was a writer that was on the side of the communists. Once he realized what the real plan was, once he saw it with his own eyes, he changed and he wrote what he believed was a fiction that would happen if you're in 1930, 1936, 1984, looks like really a long ways ahead. So he wrote what their plan in 1930 was if they won the war on the communist side. One of the things he says in the book is that you start changing the words. You start to say words and attribute the opposite meaning. Like I give you a quick example, and this is not to frame and it's not to insult anyone. When I came to the US years ago, I found that there were these people calling themselves liberals. Liberal comes from the Latin libero, which means freedom. So I thought, oh, that's great. I'm a liberal. And then when I started to see what their plank was, what they were like advocating for, I said, but this is nothing to do with liberal. This is socialist, this is communist. How come that they call themselves liberals? Same with the word progressive. There is nothing progressive about progressives. The progressives were already tried in Athens 200 years before Christ, and that failed utterly. So there's nothing progressive about that. And like that, you go on and on. The word capitalism, that really was invented by Karl Marx to describe what he believed was an unfair practice that he saw, and so on and on. So this is the battle of the mind. Right. It has nothing to do with economical concepts. It's the battle of the mind, and the real battle takes place within your ears.
That is fascinating. So one of the things Jim Rohn says, economics is major. And it's so important because economics is not like this science that they try to make it about. It's from the, correct me, it's the Latin root is, I always say it wrong, economos, which basically means house manager, right? It's just exactly scarce resources and you're managing, here's my income and here's what I need to spend to run my household.
Well, this is the most, and sorry to interrupt you, but this is very interesting. I studied, when I was at the university, I studied business and economics. And one of the first things they teach you in economics is false. They say resources are scarce and therefore you have to allocate it. That is completely false. Resources are plentiful, but I don't want to go into that because it would be like 2 hours. Right. But one thing is this, like you correctly pointed out, economics comes from a Latin word, which ultimately comes from a Greek, which basically means house management. Yeah. How to correctly manage your household. Not because resources are scarce, but simply because a good house requires proper management. That's all economics means.
Wow. See, see, so it's not complicated. This is kind of what I do. I tell people, look, you can't control the economy at large, but you can manage what I call your personal economy, which is your production and consumption as a family, right? And so one of the things that we're talking about with mortgages, because like this is so interesting to talk because like our monetary system is debt-based because the dollar is a Federal Reserve note and it's based on debt. And so because it's based on debt, and so I want you, because what happens is Alejandro is weird because you can hear we haven't talked about rates, mortgages, whatever, because you're starting from a macro position of understanding the world and what's going on and everything. And now you can go, because it's principles, the way we always teach it is principles first, then principles drive strategy, right? And strategy drives tactics, what you do, the products you buy. And so I always approach stuff. That's a framework of how I think about all this stuff. And so talk about, so many questions are flowing through my mind. Start talking about something. I'll put you back on that. So talk about money, our debt-based stuff. Just share your brilliance with them.
This is the interesting thing. The principles of money and exchange of transactions, they survive and they take precedence over like the dead money system. Yes, we are in the dead money system, but that only complicates things a little bit, but the underlying processes are exactly the same. So whenever you're going to transact, you and I agree on a value and you and I agree on a product, regardless of what we used to exchange. Could you repeat your question again?
So
I want to go over.
So the question is, I guess, so being that how do you see what you do? So you are in mortgages, right? What do you do? Like, what is it? Why do you do it? What do you do? Let's start with that. And then I'll go a little bit deeper because you think about this stuff differently from anybody I've ever heard. And yet you're using this vehicle called a mortgage, but your focus is on creating wealth. How does
Yeah.
the mortgage help people create wealth?
In the following manner. Yes, we're in a debt-ridden system, and yes,
Mhm.
we're in a system that is far from optimal. But still, like people that are like I consider myself an example of this. Somebody who is a business owner, somebody who is an entrepreneur, like a budgeting entrepreneur or an artist, always has a problem on getting a mortgage. They always do. They don't fit the boxes.
Right.
So they are basically, what we do is we see where they are, we see what the boxes are, and we make them qualify for a mortgage so they can access the fruits of this debt system. Because even though we're in a debt system, it doesn't mean that you cannot be successful. It doesn't mean that you cannot get your dreams come true. Debt system is something that is beyond my control and is beyond most of my clients' control. So we have two options. We have the option of going into a mountain, doing it all by ourselves, which some people do. And there is nothing wrong with that. And don't want to put those people down. But for the vast majority, that's not a viable option. So since this is not a viable option, how can you still keep your integrity, but at the same time use the debt system in a way that enhances your life?
Right.
So there is a section, I was reading a survey the other day that says about 6 million people in the United States belong to this category of the self-employed, the business owner. That is a very small segment when you compare it to the like tens of millions of people that work for a company that have a W-2. So that's why the lending industry doesn't really care about those people. They call them the non-QM crowd or the non-qualifying mortgage crowd. Now, when I say non-qualifying, I'm not saying they do not qualify, because they do. This is just a term that was, again, you have to go to the words. This was a wording created by Fannie Mae and Freddie Mac, which are the main agencies that buy mortgages, to describe people they would not do mortgages.
Okay.
See what that means?
Yes.
But what I see routinely is this. I see that my clients do qualify. They do have money. They do have cash flow. They do have assets. They can pay for the mortgage. However, they cannot get it because they don't fit the boxes. And that to me irks me very much.
Right.
So I do this not only because I can make money, I do it because I don't see many people doing this.
Because it's work, right? Because you got to know how to read 1120. You got to learn how to, and a lot of underwriters don't know how to do that. A lot of loan officers don't know how to do that. So they want like simple, let me see your W-2, blah, blah, blah. And so talk about that, because I think that's most of my audience are like business owners, like real estate investors. And it's, so when you're looking at that, what's different about how you see them and begin to underwrite them and help them get into debt? Like tell them about that, and then maybe how they need to kind of begin to organize themselves. That's two questions. I'm sorry, to qualify to work with somebody like you.
Okay. Usually what I do, I looked at the whole picture right away. If they come to me and say, Alejandro, I want to buy a house, so give me the best rate, because that's usually the approach.
Yeah.
And it's never about the rate, but I don't say that, because if I say it at the beginning, they would think that I do not understand them. So I approach this from a financial planner point of view. I said, okay,
Yes.
you want to buy this house? Cool. What is the house? How much is it going to cost? And then I start from that point. I start from the macro to the particular, rather than saying, send me your tax return, let me run your credit. I don't go that way at all. First of all, I spend about an hour just listening to them. I listen, and then based on what they're listening, I start to do my calculations on the background, sometimes in my head. The guy says, I'm a business owner. I want to buy this $2 million home. Automatically in my mind, I go, well, this is going to be like a $9,000, $10,000 a month payment. And then once I finish listening to him, if everything he says by word of mouth fits, then I go to the next step. And my next step is very simple. I just ask for very limited pieces of information just to confirm what the person described to me. If that now fits, then it's when I go, okay, you know what? It looks like you would be qualified to do this. We need to go a little bit deeper. Why don't we proceed with the mortgage application? But the mortgage application comes later, doesn't come at the beginning, comes only when I see that they can really qualify. And I can tell you that for business owners, I had this happen many times when they call me and they say, Alejandro, I don't know if you can help me. I have already been rejected by 2 or 3 mortgage brokers. What can you do for me? We routinely qualify those people. The number one mistake that people assume is that because they have a lower credit score, they won't be able to access a mortgage.
Mm-hmm.
A mortgage or a loan is based on income. Income is the foundation of the loan. That's 90% of the loan. If you can demonstrate that you can make a certain income, the loan is 90% done. Then credit, it's so it can be priced because they use what they call a risk-based model, which
Right.
means, I'm not saying that I agree with this, but this is the way it works. If you have a lower credit score, they're going to ask more of you and they're going to charge you more, which doesn't make any sense because if you make less money and you could default, what give you a loan to begin with? If they charge you more and you are a risk, guess what? You have more chances of defaulting, right?
Right. Right.
But they don't think that way. They think, well, you're riskier. We're going to charge you more. We're going to make life harder for you. So now you can really default.
Right.
And then they're going to say, hey, you were right. You see, you didn't qualify. So 90% is income. I would say 20% is credit. And then the last bit is the collateral. People go, well, I have this house. It's worth $1 million. It's paid off. How come nobody can give me a loan? It's because collateral is the least important piece of the loan. So you have income, number one, 90%, credit, 10%, and a little itty bit collateral. So for a business owner listening to me right now, for an artist, this is what I would do. How can you document your income? And you can document it in many ways. For that, you can call me, you can send me an email, and we can work around that. Then I will work on the credit, by the way. Usually in 1 to 2 months, we can help people with their credit. Even though we don't do that, that's not what we do. We don't charge for that.
Right.
But we routinely help people with their credit. They get 50, sometimes 100 points increase just by making a few changes.
Mm-hmm.
And there is a guy on the internet. His name is Philip Tyron. And he has a website called 720 Credit.
7 steps to 720. Okay. Yeah.
7 steps to 720.
Mm-hmm.
We have no affiliation, by the way, with him. He has the best system. If you want to improve your credit, it's the best bar none that I have ever seen. So basically, the way we help people to answer your question is by listening, seeing how there are like 8 ways to document income. So by listening to the person, I already see which of the 8 ways, this is in addition to tax returns, by the way, which of the 8 ways we're going to use. Then when we go into credit, if we can do something or if he or she can do something to increase it, we rather wait a month or 2 and do that rather than do the loan right away. And then one thing that I focus my attention is, okay, once we do all of this, we come to a payment, so many $1,000s per month. I spend quite a bit of time saying, okay, can you make this payment? Are you able to make it for the next 5 years sustainably, meaning that you're not like, feeling that you're going to die every time that you make this payment? Why 5 years? Because after 5 years, inflation alone is going to make that payment less, even though it's the same number.
Yes. That's because I tell people, like, that's why you don't want to pay your house early, because the inflation is already doing it for you. So because your income goes up, so that payment feels less than it was when you started, just because the purchasing power is going down. And so that's one of the ways to use debt to put you on the how you can benefit from inflation, so to speak.
And let me say you one more thing that this I learned a long time ago in the 90s. I went to a financial seminar in England. At the time I lived in England, and that was the best financial seminar even today that I ever went. There is one thing is the theoretical side, and one thing is the practical side. So in theory, you could have all these formulas, you could have all these investment strategies, but then it comes to practice. This is what happens in practice. Unless you're forced to pay a bill, you won't pay it. Right. That's why people don't invest in whole life insurance, which is the best investment there is.
Right.
That's why people don't save. Although saving doesn't require much explanation or any kind of a school degree, everybody knows that's what you should do. But pretty much no one does it. Why? Because there are 2 practical laws. One law says that you will spend every single cent that you think you have, not that you make, that you think you have. Example, your boss comes in, says, hey, Curtis, I'm going to give you a raise. I'm going to give you $100 more per week. Guess what? He hasn't done it yet. You haven't even received a check. You already spent $100.
Yes, mentally,
Yeah. So
Right.
I'm guilty of that too, by the way.
Yeah.
I'm not saying that I'm completely new to
Mhm.
this, by the way. So rule number one, you will always spend all of the money that you think you have.
Right.
So how can you save? How can you invest in a whole life insurance? How can you get any money thinking like that? Rule number two, you have to make the saving a necessary expense.
Yes.
This is where the mortgage comes in, because many people will attack me, will say your mortgage is not a good investment, paying your house down is not a good investment, and to a certain degree they are right. But let's go to the practicality of it. If you get a mortgage coupon every month that you have to pay, you view this as a bill. You don't view this as a saving vehicle. But guess what? Every time you pay that mortgage, some of that money is coming back to you. Some of that money is coming back to you all of the time. I'm not even talking about the tax deductions or other things. Now, you might say, yeah, but instead of paying your mortgage, you should do this, you should do that. And it's true. I'm not saying you shouldn't. But when it comes to what you will do, when it comes to what I have seen over 15 years, this is what I've seen. People have been paying their mortgages. They have been like being completely saddled with bills, worried. They don't know what to do. And then after a few years, they have all this money. They didn't know where it came from. It came from paying your mortgage because you have all this equity built up. This is not even considering the appreciation,
Right.
because you also get a little bit of appreciation, although we're getting into a very uncertain time. So I don't know if this appreciation will continue at the rate it has been. But paying your mortgage the way it can help you, it makes savings a necessary expense. And you could argue, well, it's not a good strategy. You don't get a good rate of return. You shouldn't do it. All of that is true. But when it comes to practical terms, if you're going to do nothing else, do it. You need a place to live anyhow. In
Right.
most part of the country, buying is almost equal or better than renting, except if you're like in Southern California where we are, which is a little dicey. But apart from Southern California or Northern California, most of the country, it makes sense to do that.
I love that. Yeah, it's like one of the things like the richest man in Babylon says, make of your home a profitable investment. But what I take that to mean is one of the things you said was what is the payment? Like it shouldn't be more than, I remember when I was doing it, it was like 35% of a lot of people, I'll see people and their ratios, like it takes 2 payments of their job to make them, then now you're struggling, right? You should be able to make the payment in one of your first check of the month should be able to cover your mortgage. Like little stuff like that. It needs to be so that you're not stressed out because the house, if the mortgage is too big, well, they don't come with furniture last time I checked, right? And you got to light them, you got to heat them, you got to landscape them. So you have to, each expense like that has an orbit of other stuff that goes with that. And a lot of times people don't look at the total scope. I was at a meeting last week. I was in San Diego, as a matter of fact. And we call it your housing expense. Like it costs money to sleep indoors. So whether you rent or own, and you'll always have a housing expense.
Yes.
Right. And as part of your life, because you want to sleep, you don't want to sleep under a bridge, right? And if you pay the house off, you still got to build, you still got tax, you still got to light it, so you'll always have an expense allocated for housing that will never go away. So and the key is to take control of the equity. But I think that because one of the things that if, for example, so we talk people out of making big down payments. Do you agree with that before I go here? More than they have to.
I think it depends.
Okay.
I think it depends. Like I said, I approach these scenarios from a financial professional point of view more than a mortgage professional. There are 2 things at play. I remember this family that I helped buy a house. Their monthly income and the house, what they could afford to pay on a house was a certain ceiling, and it was no more than that because the husband and the wife didn't make any more money. Here in Southern California, that was almost impossible. For the kind of money they could afford to pay monthly, there was no house selling for that price. So their family said, you know what, we'll give you the down payment. And they were willing to give them a down payment big enough so the debt became within what they could afford. So in that case, I would say, do it, because you're going to spend the money anyway. You need a place to live. Now, all you're buying is 30 days to be at a place. That's it. Let's just get a number. Let's say it's $3,000. The $3,000 go and they buy you, let's say, you pay $30, you pay $3,000, all you get is the right to live there.
Right.
After the month is over, you're done.
Right.
If you pay a mortgage, at least 1,000 start coming back to you right away, and then eventually half, and then eventually all of it comes back to you. So you're getting more, and you're getting the possibility of appreciation. Now, that's one case. Another case. We are living very interesting times right now where inflation is really skyrocketing. You know, and this is the beauty of this. When you let people free, they don't have to be an economist. They don't have to have a degree. People that have any money lying around, they already sense that their money is at risk. And I'm not talking about, like, say you have 100,000 in Wells Fargo. I'm not talking that somebody's going to steal that money. But if you have $100,000 in your bank, in a savings account, I don't have to tell you anything. You already know that it's just a matter of time, very short time between those 100,000 are not going to be 100,000 anymore.
Right.
The statement still is going to show 100,000, but you know that you're not going to be able to have the same purchasing power. People already know this. So this is what I'm seeing. And again, not from a theoretical, from a practical viewpoint.
Right.
People instinctively know they need to get the money, put it someplace. Otherwise, it's going to disappear. It's going to remain there in terms of numbers, but in terms of purchasing power, it's going to disappear. So I see a lot of people paying big chunks, big down payments now on homes. Why? Homes are very expensive. But two, they want that money to be someplace. So even if everything goes bad, there is something that they can say, my money is here. So if we were in a perfect economy, if we were like in the 1970s or in the 1980s or in the 1990s or the beginning of the 2000s, and you said to me, Alejandro, should we minimize the down payment and maybe with the rest put it on a financial instrument? I would have said yes, all day long. But when things get tough, like now, and when things get uncertain, then if you say, Alejandro, you know, I have these 100 Gs, I'm not a financial advisor, I don't understand these things, I just want something simple, buy a house.
So why is it good to own now property? So it's your house, it might be investment property, maybe. In your opinion, as a banker, as a mortgage broker, why do you think it's always a good time to own property, but why is it a good time to own property now?
I think it's good to own property at any time. Timing the market never works. I never forget this article. In 2005, when I started my mortgage career, I read an article on a magazine. There was a couple in LA wondering whether or not they should buy this $300,000 home because according to them, it was really worth $250,000. That was the top of the market, or it started to be the top of the market, although the top of the market didn't come until 2007. And that house that they were wondering whether or not they should buy 300 today is probably $1.2 million.
Wow.
And this is what I've seen over and over, not just in Southern California. I've seen this in Chile, where I'm come from. I've seen this in Mexico. But I'm going to take the Chilean example because people might think, well, we're in the United States, we're an exception. I'm going to take Chile. Chile is a country that, even though it did very well, unfortunately, what is happening here already took its whole turn in Chile. So Chile is doing very bad right now. One of my best friends, she's a university professor. So she's sort of okay. She bought an apartment. I'm not talking about a house. I'm not talking about an investment property. I'm just talking about a regular apartment. A few years ago. Today, that apartment doubled in value. That's in a country who is now socialist. That's in a country that is going downhill. That's on a currency that is not the US dollar. So this, I see it over and over. If you have limited funds, if you're not an expert, if you're just a regular person that enjoys your job or you want other things in life, you don't want to spend all your time looking at charts. I have a brother who has like 3 monitors. He plays the market. He's up at 6 o'clock in the morning, but that requires a certain kind of person.
Right.
If you're not that person, if you're a normal person and you want to leverage your income, buy a house. Why? Because you're going to make this payment. This payment is going to hurt you at the beginning. But as years go by, the payment is going to become more and more insignificant due to inflation. And then all of a sudden, 5, 6, 10 years from now, you're going to see all this money that you don't know where it came from. It came from what you paid on your mortgage, and it came from the appreciation on your home. You see, the rich people, that's how they make their money. Rich people don't make their money by working for someone else. They make their money by owning assets.
Right.
As those assets could be properties, they could be businesses, they could be systems. As those assets increase in value, their portfolio, their value increases a lot more than what they could if they just worked. So it's not that they don't work. Some people say, well, rich people don't work. They do work. They do work like crazy, by the way.
Right. Yeah. Yeah.
12 hours a day or more. But their money doesn't really come from that physical work. It comes from the appreciation of the assets that they create.
That's
By
awesome.
the way, what Karl Marx did not observe. He thought that the business owner, by taking the 40, I mean the spread between the $10 he paid the worker and the $50 he sold the product for, he saw that he didn't give any value to those 40. He didn't give any value to the entrepreneur. He didn't realize that because the entrepreneur risked his life, his capital, and probably his family to create the condition to be able to pay the worker $10 every month, no fail.
Right.
Because he did that and because he created a system, that's why he could pocket the 50. He didn't realize that it's not just a matter of making a product. You have to make it, you have to sell it, you have to give value to the consumer. Otherwise, the consumer is not going to pay anything for it.
Yeah, I mean, it's funny because you're like in the niche you focus on of people that are kind of out here making it happen. They really need somebody like you that understands what is going on and the pressure that we have to make payroll, to do all this stuff where we're handling a lot of money, but so the cash flow is there, but because what I think I teach people is that planning is different. It's like completely opposite for entrepreneurs than it is for employees. And a lot of people go into business and they'll do the Susie Orman, Dave Ramsey stuff, but it doesn't work for business owners because they're teaching you to send money away from you, right? And where you need control, liquidity, use control of your capital, because you can actually make your business make more money than some fund manager you never met.
Exactly. Business people and entrepreneurs work on cash flow.
Yes.
They don't necessarily work on profit and loss. Yes, they do make a profit,
right?
But they work on cash flow.
Cash flow,
I give you an
right.
example.
Right.
They have $1,000. They have two options. They can pay a bill or they can put it in their business. An entrepreneur will immediately put it in the business. Would say, you know what, I'm going to be late on the bill. I'll pay the $30 or whatever late fee. I don't care. I'll pay it.
Right.
And this is where he comes in juxtaposition with the system. The systems, because this is one more thing that I want to tell you. Credit scores do not measure your success. Do not measure whether you are responsible. They do not measure whether you are moral. All of those thoughts, in my opinion, are propaganda. The credit system was created by bondholders to be able to spot the people that would make them the most money. Because think about this. If you're a bondholder, if you have $100 and you want the $100 to give you every month a certain return, you want to look for those people that would do that. You don't want a business owner that is going to say 1 month, you know what, I'm not going to pay you now, I'm going to pay you next month. You're going to charge me $30. I don't care. I'm going to do this other thing.
Right.
Now you're the bondholder. No, I need that income.
Right.
So you're going to immediately create a system that puts those people away. You don't want those. You want the guy that goes to work. You want the guy that comes home, that pays all of their bills first.
Right.
And what is left, if any, is what they have. The business owner doesn't think like that at all. The business owner gets all this gross income. Obviously, this income is not his because he has to pay employees. He has to pay for the product. He has to pay for taxes. He has to pay for bills. But a business owner doesn't think like that. He thinks, okay, I got all this money coming in. How can I multiply it quickly?
Right.
Like 2 times, 3 times. Yeah, I'm going to be late here. I'm going to be late there. No problem. I'll pay the fees. It's not that the business owner doesn't pay. They do. But to them, the late fees are just the cost of doing business. They are the cost of financing. Now, that's at the beginning when you are starting. Once you become more successful, now you can afford to hire a CPA. You can afford to hire a financial planner.
Right.
So you become quote unquote responsible later, but not at the beginning.
So you just describe my life.
But then the credit system is going to penalize you.
Yeah.
You are a bad boy. You know, you didn't pay.
Because my credit was jacked and it was like, why do this?
Right.
Why is your credit bad? Because I'm in business. It's like, well, you've been in business all your life. And I was working with some company in it briefly, like 13 months, the longest job I ever had. Right. Okay. And I was still, within 13 months, it was as far from a job as you could have it. I was still doing financial services, doing the teachers' retirement plans in school district. And I still figured out why I hated it. Right. And ever doing it was like, well, why is your credit so bad? Because I've been in business for the last 15 years. And I was totally like that because I would just make money and do what I had to do. And I didn't even, now I see you got to manage a little bit better. You want to have access to other people's money. So you do need to get control of it. But it's good that they would have someone like you that specializes in servicing a self-employed borrower. If you're an artist, I think that you need somebody that can advocate for you, that understands your life, your cash flow. And that's really a cool thing. Let me ask you this last question, but you got so much stuff we can go into. I would definitely gotta get you back on. You allowed me to nerd out on economics for 20 minutes. So I appreciate that
No problem.
in and of itself. But how do you, because one thing, this is kind of the premise for your book, and I want to cut you to kind of set this up, is how, in your opinion, how do you grow wealth both on your own and that of your community? I'm really interested in your take on your philosophy around that. If it's, I don't know, that's probably a long answer, but
I'll try to make it simple.
yeah.
It's through relationships.
Mm-hmm.
You have to cultivate your relationships. When I mean relationships with your community, even this conversation is a relationship, because now I know you, I know what you do, you know what I do. We spend a lot of time here on the phone, on the internet, on Facebook. Those relationships are ephemeral. Easy come, easy goes. Just put an ad on Facebook and say, tomorrow is my birthday, I invite you. See how many people show up online.
Mm.
If one person shows up, that would be great. Let alone in person. In my opinion, what we should do, especially now that times become hard, we need to create physical, real relationships with people, because the economy and money is a social construct. Money is not really money. Money is just a symbol that we created so we can exchange things between people. Yes, there are rules of money. Yes, there are certain rules, like you need to sell something for more than it costs you. And there is a bunch of rules like that. But essentially, what money is a social construct that allows us to exchange physical things and things that we do for each other. So that tells you right away, we have to have the relationship. If I don't know Joe Blow and I call him on the phone and say, hey, I want to sell you a mortgage, he's going to say, if he says anything, I'll be lucky. I'll just hear a click.
Right.
But if I meet Joe Blow at a cafe, we exchange, he knows about me a little bit. And then I say, hey, Joe Blow, have you ever considered getting a mortgage? And he says, as a matter of fact, I was thinking about it. Do you do mortgages? Yes. That's how everything begins. Salespeople know that innately.
Yeah.
Salespeople, people that are good at relationships, they know innately. Business people, by the way, entrepreneurs know that too.
Yeah.
They know you cannot sell a product unless you really meet people. Now, you can do it online, you can do it through an ad, but the ad and the online and all that, all it gets you is somebody knocking you at the door. Now you need to do the real work.
Right.
I can put hundreds of ads online, but when they call me, that's when the work begins. All those ads, all that marketing, all that phone stuff, all that Facebook, whatever, it's just to have somebody knocking on my door. Now I need to do the real work. So because money is the result of things we do for people, and this comes back, I can't take the credit for this. This was a German business consultant that said it on a seminar that I went to in the 1990s. He says, when you don't have money, what one does do to begin with right away? Curtis, if you don't have any money, what you do?
I try to figure out something I could sell to somebody, some problem I can solve. I mean, I think that way. Now it's like,
now you think that way,
right,
but most people will go, okay, most people,
we alone.
yes, I need a loan.
Right.
Exactly. When we don't have money, we think, okay, the solution is money. And he says, that's wrong. And he says, why? He said, money is the result of having exchanged a service or a product with someone first. And then as a consequence, you get the right to obtain money in return. So if you don't have money or you're worried about money, the first thing you need to do is find people that you can do something for them. It doesn't have to be a product. It could be a product. It could be a service. It could be whatever. And you might think, well, that is too much work. I need to do marketing. I need to talk to a lot of people. At the beginning, I'm not going to make a lot of money. But there is no other way. Unless you have a rich uncle, unless you get an SBA loan from the government, gives you free money, unless you get something like that is not, by the way, natural, there is no other way. So you can wait until you drown, or you can start acting now. But it's not going to be any other way, because even when you're drowned, you still are going to have to go out, talk to people, see what you can do for them, train yourself. That is not going to happen overnight. Train yourself. You see, this society where we live now, where everything is instant, has made us forget what it really takes to survive and to prosper. All of these are tools. The phone and so on are tools, but we still need to do the same legwork.
Yeah.
You need to go out. We need to meet people. We need to train ourselves or find a product that people like. And we need to keep at it until we grow a field bigger and bigger. And then it becomes a point that it can sustain ourselves. And then if you continue to put energy, now not only can sustain yourself, you start to become wealthy. But
Right.
that's not overnight. We read, oh, this young guy bought some crypto and sold it, and now he made, I don't know, 50 Gs.
Right.
Well, yeah, but there are like 2,000 people behind him who lost their shirt.
Right.
That's not a business model you want to follow.
Right. That's gambling. You got lucky. He's not lucky, but there's money follows value. That's the main thing that's why I've been ingrained in that. So I think I always knew that because I come from a self-employed family that, and I've really, as I work with my clients, I say, listen, money. So if you say like, I don't have enough money, like if I hear a business owner and their money's tight, I immediately know they have a marketing problem, right? They're not communicating their value to enough people or that kind of stuff. So it's like, they don't get the cause and effect of that. And then if I talk to an individual or a new person trying to offer something, oh, what problem are you solving for people? Like the bigger the problem, the bigger the check. So you have to look for problems. Entrepreneurs solve problems, right?
Yes.
So you can't run from problems. You need to embrace them and then look for how your skills, talent can solve that problem. And then money's the reward for that. So I think that, because if we could get that point across and understand the freedom to transact, because there's no, what is high? This is what I learned from Nelson, right? It's like the human action, right? Ludwig von Mises is that an economy is you and I making individual decisions about exchange, right? And it's difficult. It's not difficult. It's impossible for some central planning situation, 12 people in a room to manage all of that. That's why. And so I view economics as more philosophy than science, but people want to elevate themselves at the Fed and whatnot. That it's a science and I have to do charts and stuff, but they don't understand human action, which drives all that stuff.
And the interesting thing is that in whole of human history, which depending on who you read, we're talking about 10,000 years. If you take the Sumerian civilization, that was the first civilization about 3,000 to 6,000 years before Christ until now, that's about 10,000 years.
Mm-hmm.
It has never worked.
Wow.
Never. So why people insist, or why in the universities they insist on teaching something that has never worked? If it had worked once, you could argue, well, if the conditions were right, but it has never worked on any civilization on Earth in the last 10,000 years. I mean, talk about a losing model to follow.
Right. That is so funny. That should be shouted from the rooftops. Like, look, what are you doing? This has never worked. And that's kind of one of the messages of my show. Like, not every week, but subliminally, it's like, listen, learn. There's rules to this game, and it's about. I heard F.A. Hayek say it's a ever expanding system of cooperation among strangers, right? And so I feel so. And I'll say, well, what's wrong with that? Cooperation among strangers. People like, oh, I don't know, I don't like this capitalism. Well, I was getting, and I got it from what's his name, from a strategic coach, Dan Sullivan, right? He says it basically said what you said. Capitalism has a bad name because it's got named by its enemy, Karl Marx. And so that's the problem. So
actually, when people are talking about capitalism, the proper word is free enterprise. Before Karl Marx, in the world and for hundreds of years, the system was known as free enterprise. And this is the proper name. It's free market economy or free enterprise. It's not capitalism.
The free enterprise system, right? Free,
yeah.
I love that. That's really what it is. I'm not even gonna say capitalism anymore. I'm gonna say free enterprise.
Yeah, every time that you say capitalism, you're doing Marx's work for him for free.
Okay. Dude, I'm gonna have to have you back on. We can just talk about this. But oh my God, it's so much fun. Alejandro, how they want to find out more about what you're doing, if you can help people and they're in business, they want to get a mortgage, or just let us know how to follow up when your book comes out, which sounds like it's going to be awesome. Tell them where to go. Where would you like them to go?
Yeah, I will tell you. One thing that I discovered about very successful people, I had the honor of helping very successful people, is that very successful people are always reachable.
Mm-hmm.
So I try to do the same thing. If you want to get to me, I will answer your email and I will call you.
Mm-hmm.
Write to me at info@prosperitylending.us. Info@prosperitylending, all one word, .us. My website is the same. It's www.prosperitylending.us. And if you want to get a free copy of the book of the first few chapters, we're giving away some of the few chapters. Go to the website, www.prosperitylending.us/book, I think it's called. And then just fill in your information and you'll get one of the chapters of the book for you to actually review before it's published.
Perfect. Perfect. And then once they're on your list, you'll let them know. I'm sure you'll be letting know that it's finished. They can go get the book. I love that. I'm going to be the first one on this list. Okay.
Thank you, Curtis.
And this was, so reach out to him. See, folks, you got to get, when you're doing business with people, you need to get with good people that are experts in that field, but they understand more than the transaction, right? And so if you heard anything, this is somebody who will guide you to help you understand, because the mortgage is just a financial tool. It's not about the mortgage, right? It's about becoming financial free. And so how does a mortgage help you do that? That sounds to me how to get one and how to manage it right. Because see, here's the thing about this. We were talking about this before we recorded. I didn't get back to it. I want to say this, is that if you look at your balance sheet, right? So there's two sides of the balance sheet. There's the asset side and there's the liability side, right? There's really, we used to talk about it in mortgage planning, the three-sided balance sheet, which is like, I'm more on the asset side, the paper side. There's the liability side, which is you. And then there's the realtor, because real estate is both an asset and a liability. So really, the three of us should be talking about your portfolio, right? and together, like us, we should be getting together to help you, the listener, create financial freedom between the two of us. But he gets that. See, most people just want to do the next deal.
Right. And one more thing very quickly is that the mortgage has many moving parts. Many of those moving parts are never brought to light by the mortgage broker or the loan officer because they are afraid the borrower or the client is going to walk away because they don't explain it. For example, you can buy down the rate. You have control over the closing costs. The rate is not one rate. It's 3 or 4 or 5 rates that make sense for you. Most loan officers never discuss them because I don't care about the transactional side. I see all of the options, all of those 4 or 5 rates that the borrower or the client qualifies for. We look at them in detail. We have a Zoom call and we brainstorm it together because I'm not afraid of giving them the whole range of possibilities, not just the ones that are the easiest or the most expedient and so on.
Right. I love that. Yeah, we work the same. That's very cool. Okay. So I love that. And look, any closing, I'm gonna let you have the last word. Any closing words of wisdom for my listener?
Yes, I'm going to say this. Don't shy away from learning. Don't shy away from really discovering. At the end of the day, you can hear me, you can hear Curtis, you can hear Dave Ramsey or whoever is on television. You are going to have to make the decision. I remember when I was in school and I didn't like going to school. I didn't like going homework. And my dad told me, you know what? You better get used to it because you have to learn. The process of learning never stops for as long as you live. And I remember thinking, oh no, man, I have to do this all my life. But I decided to embrace it. So don't be afraid of learning. Don't be afraid of reaching out. And don't just assume or get what people say at face value. Do a little bit of research. Today, at our fingertips, we have the encyclopedia of the world on a phone.
Come on now.
Use it.
Yep.
That would be my advice.
I love it. I love it. So I echo that 1000%. So Alejandro, listen, thank you so much for your first visit to probably first of many visits to the Practical Wealth Show. I really enjoyed our conversation today. Guys, go out there. I want you to get his book and be ready for when it comes out, because you can see there's a lot of stuff. I mean, so if you're self-employed and you're looking to buy a house or a second house, or you know what I want to talk about, I'll have to have you back. I don't have time to do it now. I meant to ask you about the reverse mortgages, providing a house with mortgage.
Yeah, that is fascinating, but that's for another show.
Yeah, so we'll do that. I'm gonna have a show just on that because I really want to have a conversation about that, because people have been asking me about it, and I don't think they're bad things. It's just a tool, right?
Yes.
And so I like the back and forth because it's really a planning tool and it's a mortgage tool that need the conversations we had together. So we'll come back as another talk. So listen, go out there. I want you to follow him, check out his site. He'll let you know where, because let me ask you this so they know. They should get the book regardless, right? But are you in the 2 states that I saw, or are you in other states? Like, where can you do business at?
We are licensed in Florida and in
California.
For now, those are the two states that we're licensed.
Right. Okay.
Now,
So
if it's a
big
business
states.
loan, if
Mhm.
it's a business loan,
Commercial.
pretty much can do, if it's a commercial loan, or if it's a 1 to 4 doors residence that you're not going to live in it, but it's an investment property.
Mm-hmm.
So if it's an investment property, either a residence or a commercial, we pretty much can do the whole country, except for 5 states. One of them is Oregon. There are 5 states that even if you do a business loan, you still have to get a license for that state.
Mm-hmm.
But one of them is Oregon, but most of them, if it's business, we can do it nationwide.
Okay. So investors, right? Non-owner occupied, commercial, and that's all right. So let's get that out there, right?
And residential investments.
And residential, right?
Yeah. If it's owner
1 to 4
occupied,
units.
yeah.
Mhm.
If it's 1 to 4 units, if it's owner occupied, it's California and Florida only for now.
Okay. For now, right? We're all expanding our reach as we do this thing. So listen, he's a good guy to know. And so make sure you reach out, and if you can, I would definitely add him to your team. I'm definitely going to add him to mine. And go out there, guys. Thanks for listening, and go make it a prosperous day. Have a great day, everybody.
Thank you, Curtis. It's a pleasure to meet you.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth.